As non-accountants, also known as normal people, we often have trouble understanding how accountants think about revenues and expenses. We usually think about revenue as times when we get cash, and that makes sense, right? I mean, to us, revenue is when we get a paycheck or when we earn tips at our jobs. And expenses are the things we have to pay in cash every month if we want to have a car to drive, a place to live, and lights to turn on. But that's not how accountants recognize revenue and expenses for a company. After all, the purpose of a company's income statement is to tell us whether management's decisions will lead to an accounting profit or not, kind of a smoothed out cause and effect over time. And that could be a very different number than how much cash came in or went out the door in any single period. So the Financial Accounting Standards Board has some very specific rules about revenue and expense recognition, 93 pages just for revenue, in fact. But they boil down to this: revenue is recognized when goods and services are provided to a company's customers, even if no cash is exchanged in the transaction. And expenses happen when value is used up by the firm, again, even if no cash changes hands. So let's look at an example. First, let's say we have a consulting company that works with local financial institutions. This month, our company provides services to its clients for which it gets paid $10,000 in cash. And the cost to the company of providing that service is $6,000, which is made up of things like salaries, office expense, and utilities. And since we're assuming this is all cash, our company has had $10,000 come in the door and paid $6,000 out the door for a profit and a cash flow of $4,000. Now, that's great, but the reality is that most businesses run on credit. They often borrow money or buy things on trade credit, and when they finally get paid by their customers who also bought things on credit, they use the cash to pay off their liabilities. That's a normal business cycle. So let's look at a more realistic example. Now, let's say that our company provides the same service for the same customer for the same $10,000. This time, though, instead of making the customer pay up front, our company invoices the customer and debits our accounts receivable. In other words, we have an IOU from our customer. So how much revenue should we recognize? Well, we didn't get any cash, but we did perform a service for which our customer will eventually pay us. And since we try to match revenues and expenses to the actions that caused them, we should record the revenue. And what about our expenses? We still used up the same $6,000 worth of employees' time, rent, and utilities, only this time we've put them into our payables on the liability side of our balance sheet. And since we used up the same amount of value, we record the same $6,000 of expenses as we did before, and we'll end up with the same $4,000 profit. The difference is this time no cash changed hands, and our cash flow is zero. It's worth noting that over time, this difference will eventually even out. We will collect the money from our customers, and we will pay off our suppliers and our employees, and we will end up with the $4,000 in cash. It just may take a little while. In other words, since businesses run on credit, thinking of revenue as cash in and expenses as cash out might mean we lose visibility into the decisions that caused that $4,000 profit in the first place. We'd have revenues all over the place and expenses randomly, sometimes separated by months from the transactions that actually caused them, and no idea of what led to what. And that's why we keep profits separate from cash flow. So remember, when you think revenue, think about when the company delivers goods or services to its clients. And when you think about expenses, think about the company using value up. If you have questions about this or anything else related to finance or accounting, leave them in the comments section. If you'd like to talk about something at length, I can always be reached through my Wyzant profile, linked here and in the description. Thanks for watching.